The Trump administration just made a new decisive move, imposing a 20% tariff on Chinese goods. It's a clear escalation in the ongoing trade war, one that Washington hopes will pressure Beijing into trade concessions. But China isn't backing down. Within days, it strikes back, cutting U.S. imports across multiple industries and shifting its focus to new trade partners. Canada and the European Union are at the top of that list. For American farmers, manufacturers, and energy suppliers, the consequences are immediate. The Chinese market, once a massive source of demand, is rapidly disappearing. U.S. businesses that once relied on steady exports to China are suddenly facing uncertainty, overproduction, and falling prices. Meanwhile, Canada and Europe are stepping in to fill the gap, capitalizing on Washington's aggressive trade policies. What started as an attempt to force China's hand is now looking like a major miscalculation. But was this simply a mistake by the U.S., or was it part of a larger strategy? One of the biggest shifts is happening in energy. For years, the U.S. was China's primary supplier of crude oil and natural gas. American energy exports played a critical role in meeting China's growing energy demands, and billions of dollars flowed between the two countries. But that relationship is now unraveling. In March 2025, Washington took another step in its economic crackdown, imposing a 10% tariff on Canadian oil imports. The goal is to pressure Canada into renegotiating trade terms in favor of the U.S. Instead, it backfires spectacularly. Rather than caving to U.S. demands, Canada quickly finds an alternative customer: China. Beijing wastes no time, immediately ramping up oil imports from Canada, taking advantage of the newly expanded Trans Mountain Pipeline. This isn't just a small adjustment, it's a massive realignment of global energy trade. Before the expansion, the pipeline could handle around 300,000 barrels per day. Now that number has skyrocketed to 890,000 barrels per day, providing Canada with a direct, cost-effective route to Asia. Within months, half of Canada's crude oil exports are flowing into China, a major shift that significantly reduces Beijing's reliance on American energy. But oil is only part of the equation. Liquefied natural gas, or LNG, has also been a crucial component of China's energy supply. For years, the U.S. was one of China's biggest LNG suppliers, shipping millions of tons of natural gas to fuel China's industries. But that relationship is breaking down fast. With Washington imposing trade restrictions and tariffs, China is actively seeking alternatives, and once again, Canada is stepping in to take the U.S.'s place. The timing couldn't be better for Canada. The LNG Canada project, one of the largest natural gas export terminals in North America, is set to begin operations in 2025. With an export capacity ranging from 14 to 26 million tons per year, it positions Canada as a major LNG supplier on the global stage. China is eager to secure new energy deals, and long-term contracts between Beijing and Ottawa are quickly being signed. This isn't just about trade, it's about security. China has long been working to diversify its energy imports to avoid being overly reliant on any one country, particularly the U.S. By expanding partnerships with Canada, Qatar, and Australia, China is insulating itself from the risks of future trade disputes. It's a calculated move, one that strengthens Beijing's negotiating power while simultaneously weakening the U.S.'s influence in global energy markets. For American energy companies, this is a nightmare scenario. Losing China as a primary customer means billions in lost revenue. And unlike some industries that can pivot to other markets, energy suppliers don't have an easy way to replace China's level of demand. While some American oil and LNG may find buyers in Europe or other parts of Asia, those markets are already saturated with competition. The reality is that Washington's trade policies are making American energy less competitive, and China's shift toward Canada is locking in a new energy dynamic that could last for decades. But the biggest winner in all of this is Canada. For years, it was overshadowed by the U.S. in global energy markets. Now, thanks to Washington's own tariffs and restrictions, it's emerging as a major player. Canadian oil and LNG exports are surging, and China is building long-term trade relationships that will strengthen its position in global energy networks. What was once a secondary supplier is now becoming a critical energy partner for the world's second-largest economy. The effects of this shift extend beyond energy. It's part of a much bigger story, one where global trade alliances are being rewritten in real time. The U.S. believed it could control the terms of trade by imposing tariffs and restrictions, but instead it's pushing its own partners and customers into each other's arms. Canada and China are forming stronger ties, Europe is benefiting from redirected trade, and American businesses are left dealing with the fallout. The long-term impact of these energy shifts is impossible to ignore. If China continues to prioritize Canadian and other non-US energy sources, American producers will be forced to find new markets or cut back production. That could mean job losses, lower investment in energy infrastructure, and a decline in US influence over global energy prices. Meanwhile, China's strategy of energy diversification is positioning it as a stronger, more resilient player in global trade. But this is just the beginning. The energy sector is only one piece of the puzzle. The bigger question is whether the US can reverse these trends or if it's already too late. Because if Washington continues down this path, it won't just be oil and LNG that China starts sourcing elsewhere. Agriculture, manufacturing, and technology are all next in line. And as Canada, China, and the EU build deeper trade partnerships, the US may find itself increasingly isolated in the global economy. What started as a trade war is now turning into something much bigger, a fundamental shift in global economic power. The US believed it could force China and its allies into submission with tariffs and trade restrictions, but in reality it may have just accelerated its own decline. The question now is whether Washington can adapt to this new reality, or if it will continue down a path that pushes its biggest trade partners even further away. China has been a massive buyer of US agricultural products for years, fueling American farms with billions of dollars in demand. But with trade tensions boiling over, that relationship is now falling apart. Washington's decision to impose tariffs on Chinese goods in early 2025 was meant to pressure Beijing into compliance. Instead, China has responded with its own set of countermeasures, slashing US agricultural imports and turning to alternative suppliers. The results are devastating for American farmers. Soybeans are the first major casualty. In 2016, the US accounted for nearly 40% of China's soybean imports. By 2024, that figure had dropped to just 18%. Brazil and Argentina have stepped in to fill the gap, now supplying a combined 74% of China's soybean demand. It's a major blow to US agriculture, which has long relied on China as a key export market. But it doesn't stop there. Wheat, corn, and cotton, once critical American exports, are now being replaced by South American and European suppliers. China is shifting its food supply chains away from the US, diversifying its imports to countries that aren't caught in trade wars. The European Union, particularly Spain and the Netherlands, is seizing the opportunity, boosting its exports of pork and other meats to China. For American farmers, this shift is nothing short of a nightmare. Losing China's demand means dealing with massive oversupply, falling prices, and shrinking profits. The impact is particularly severe for smaller farms, which don't have the resources to quickly pivot to new markets. Many are being forced to sell at a loss or cut back on production entirely. Some are even facing bankruptcy. And it's not just farmers who are feeling the heat. The entire US agricultural industry is suffering as China cuts back on American goods. Processing plants, transportation companies, and equipment manufacturers are all seeing declines in business as the ripple effect of lost exports spreads through the economy. The numbers tell the story. In 2023 alone, the European Union's pork exports to China surged by 35%, while US pork exports plummeted. Chinese tariffs and stricter inspection policies have made American meat less competitive, while European suppliers have stepped in with more stable supply chains and pricing that appeals to Beijing. For Washington, this situation is spiraling out of control. The Trump administration assumed that applying tariffs on Chinese goods would give the US leverage in trade negotiations. Instead, it has handed China an excuse to accelerate its long-term strategy, reducing reliance on American suppliers and strengthening trade ties with other countries. And agriculture isn't the only sector feeling the impact. America's industrial sector is also under pressure as China begins to cut investments and shift its business elsewhere. Tech giants like Google, Tesla, and Intel, which once relied on China as a major market, are losing ground. Chinese companies are now turning to Canada, Europe, and BRICS nations to fill the gap, reshaping the global tech landscape in the process. For years, the US has been a dominant force in global trade, but this trade war is changing everything. Canada and the EU are winning, capturing billions in lost US trade. American farmers, tech companies, and industries are struggling to stay afloat. And the longer this standoff lasts, the harder it will be for the US to regain its position. The big question now is whether Washington will change course to reclaim lost ground, or if it will double down on tariffs, further isolating American businesses from global supply chains. Because if this trend continues, the long-term consequences could be severe. China's aggressive trade diversification is creating new alliances that could permanently reshape global economic power. The deeper China builds relationships with alternative suppliers, the less it will need the US in the future. And that's the real danger Washington faces. This isn't just a short-term trade dispute. It's a structural shift that could leave America with less influence, fewer trading partners, and an economy that is increasingly vulnerable. In December 2024, during a meeting at Mar-a-Lago, former President Donald Trump made a statement that sent shockwaves through Canada. Standing before a crowd of supporters, he casually suggested that Canada could become the 51st U.S. state. At first, some dismissed it as just another offhand remark, but as the comment circulated, it became clear that this was more than just a joke. Canadian leaders reacted immediately. Prime Minister Justin Trudeau wasted no time in responding, firmly stating that there was zero chance of Canada ever becoming part of the U.S. Across the political spectrum, Canadian officials and citizens alike saw the statement as a direct insult to the nation's sovereignty. It wasn't just offensive, it was a threat. The backlash was swift. Within days, a massive boycott campaign against American goods and tourism gained momentum. Social media flooded with calls to ditch U.S. products, and local businesses started taking action. In Quebec and Nova Scotia, American-made alcohol was pulled from retail stores in protest. This wasn't just about symbolism. It was an economic response to what many Canadians saw as blatant U.S. overreach. But Trump's comment was just one part of a larger economic battle between the two countries. Washington had already taken steps to strain U.S.-Canada relations, imposing tariffs on Canadian goods. The most significant was a 25% tax on Canadian imports, excluding energy. The move was meant to pressure Canada into renegotiating trade agreements, but instead, it ignited even more resentment. Canada wasn't just going to sit back and take it. In response, the boycott movement grew stronger, particularly in the tourism sector. Every year, more than 20 million Canadian tourists travel to the U.S., spending billions of dollars in American hotels, restaurants, and retail stores. Now that number is shrinking fast. Travel bookings plummeted, and American tourism hotspots in states like Florida, California, and Texas started to feel the sting. One of the hardest-hit industries was American alcohol. Canadian provinces not only removed U.S.-made alcohol from shelves, but they also encouraged consumers to buy local brands instead. The bourbon industry in Kentucky, for example, saw a major decline in exports to Canada, a key foreign market. This economic standoff was turning into something far more serious than just a few tariffs. The U.S.-Canada relationship, once one of the strongest in global trade, was now at risk of long-term damage. Washington's tariff policies weren't just affecting businesses, they were fueling deep political and economic resentment in Canada. The biggest question now is whether the economic ties between these two nations can recover. When politics and trade collide like this, the fallout can last for years. Canadian businesses that once relied on the U.S. market are looking elsewhere, diversifying their trade partners to avoid future economic shocks. And as the U.S. doubles down on its America First policies, Canada is taking steps to reduce its reliance on American imports. What started as a few offhand comments and aggressive tariff policies is now reshaping the future of North American trade. The longer these tensions last, the harder it will be to undo the damage. Canada has made it clear, it will not be bullied into submission. And if Washington doesn't rethink its strategy, it may find itself losing one of its most valuable trade partners for good. The United States has long been the dominant force in global trade, but in 2025, cracks are beginning to show. While Washington remains locked in trade battles with China and Canada, a new shift is happening, one that could permanently alter the balance of power in international commerce. At the NATO and EU summits, Canada is making a bold move, one that directly challenges the US's influence in Europe. For years, European nations have depended on American imports, from energy to technology and manufactured goods. But at these high-level meetings, Prime Minister Justin Trudeau delivers a clear message. It's time for Europe to start reducing its reliance on the US and consider a different trade partner, Canada. At first glance, this might seem ambitious. After all, Canada has always been seen as an economic ally of the US, not a direct competitor. But Trudeau and his team come prepared. Canada has several key advantages that make it an attractive alternative to American suppliers. It boasts a modern and highly reliable manufacturing industry, abundant and stable energy resources, and a booming aerospace sector that's gaining recognition worldwide. One of Canada's biggest assets in this push is its trade deal with Europe, the Comprehensive Economic and Trade Agreement, or CETA. This agreement, which has been in place for years, gives Canada easier access to European markets, something the US lacks, Now, with tensions between Washington and its trade partners at an all-time high, Canada is in the perfect position to capitalize. If even a small portion of European imports shifts from the US to Canada, it could deal a significant blow to American businesses. A trade diversion of just 5 to 10% could cost the US economy billions of dollars in lost revenue annually. And this isn't just about numbers, it's about prestige and influence. If Canada successfully positions itself as a viable alternative to the US, Washington's grip on global trade leadership could weaken. The question now is how the US will respond. Washington has two choices. It can either ramp up trade incentives to keep its European partners tied to American suppliers, or it can try to undercut Canada's momentum by imposing new tariffs or trade restrictions. Both options come with risks. If the US aggressively pushes back against Canada, it could further alienate European leaders who are already looking for more stability in their trade relationships. But if it does nothing, it could watch as Canada slowly erodes its influence in key global markets. And this isn't just about trade deals on paper. Real industries are at stake. One of the most high-profile examples of this growing trade war is Canada's recent move to impose a 100% tariff on Tesla. The electric vehicle giant has long dominated the US auto market, but in Canada, its future is suddenly in jeopardy. Tesla has been a symbol of American innovation, holding more than 70% of the US electric vehicle market share. But now, with Canada proposing a 100% tariff on Tesla imports, that dominance is at risk. If the tax goes into effect, Tesla prices in Canada could skyrocket, making its vehicles nearly unaffordable for most consumers. A Tesla Model 3, which currently sells for around $40,000, could see its price double overnight, effectively crushing demand. The consequences of this move would ripple far beyond Tesla itself. Investors would be spooked, potentially driving down the company's stock value. The broader North American auto industry, including giants like General Motors, Ford, and Chrysler, could face serious disruptions as trade tensions escalate. But it's not just about protecting domestic manufacturers. This tariff is a direct response to Washington's aggressive trade policies. Canada is making it clear, if the US continues imposing tariffs and economic pressure, it won't hesitate to retaliate. And in doing so, it's opening the door to European automakers who are eager to gain a stronger foothold in North America. This trade war is about more than just cars. It's about control over the future of energy, technology, and global commerce. If Canada follows through with its Tesla tariff, it won't just be an economic penalty. It will send a message that America is no longer the only dominant player in North America's economy. The electric vehicle industry is one of the fastest-growing sectors in the world, and Canada's decision could reshape how automakers strategize their expansion. If Tesla and other US car manufacturers lose access to the Canadian market, they could be forced to make significant changes to their pricing, production, and export plans. The US-Canada economic relationship has always been close, but right now it's at a critical crossroads. The longer these tensions last, the more difficult it will be to repair the damage. If the US continues down its current path, it could find itself isolated not just from China, but from some of its closest allies. And Canada isn't waiting around to see how Washington will react. It's already building new partnerships, strengthening ties with Europe, and exploring deeper trade relationships with China. This isn't just about fighting back against US tariffs. It's about positioning itself as a rising economic powerhouse, independent of American influence. The question now is whether the US will recognize this shift before it's too late. Because if it doesn't, it may wake up to find that Canada, once seen as its junior partner in trade, has quietly taken its place on the world stage. And that would be a loss far greater than any individual tariff or trade dispute. It would be a fundamental change in the global economic order, one that Washington might not be able to reverse.